Okay, hi, I'm Terry Bennett, the money coach at Max Money Center. And Joanne?
Hi, everybody. Good evening. Thanks, Terry, and thanks to Ian and the group. My name is Joanne Martiri, and I'm the Regional Director for National Accounts at Manulife Bank.
Okay, so we are going to be your co-host tonight, and I'm so glad that Joanne is actually joining us because I've done this webinar before for alumni, and what was missing was a bank mortgage aspect to it. Lots of questions about that. So Joanne has been wonderful enough to join us. So that should make it a very informative evening. We have a lot of information to cover. So we'll try to do this as quickly as possible and have time to get to your questions. So I'm going to start this off with 4 questions, 4 statements that people make about housing. And I'd like you to just say whether yes or no is the answer, whether you agree or you don't. And so can we have the first question, please? Okay, homes are always a good investment. Yes or no? And Ian, if you can tell me what the percentages are.
You got it, Terry.
Thanks.
As of right now, it looks to be 57% for no, 58% no, 42% yes.
Okay, well, that's interesting. So this is my take. I'm actually going to tell you how I feel. If Joanne has a different perspective, maybe
Sure.
that would be neat to hear hers. I don't think homes are always a good investment. I think over the long term, when you look at house sales historically, homes over time do end up generally they end up being higher. You know, the prices do definitely go up and you can make some money. But the other thing in that is it also relates to how well you've maintained your home over all the years, and also if you've added value to your home, that will also help increase the value. If you're looking in the short run for a home, I would say that really it takes about 5 years to recoup the closing costs that are associated with home buying, and we'll talk about the closing costs in a bit. And if you're going to do something that's very short, a buy that's very short, probably renting is a better opportunity for you, and you won't probably make a lot of money. Okay. Number 2 then. It's smart to buy the most house you can.
As of right now, it looks to be an overwhelming percentage of no at 95%.
Oh, I'm so
Yeah.
impressed. Good for you guys. Yeah, you know what, when you do get approved by a financial institution, they are looking at very specific things that they think you can afford, but they're not really looking at your goals and your values and your saving needs and what you plan on doing in your life. So you don't want to be married to your house. You know, you want that opportunity to have extra money for the kind of lifestyle you want. So good, great answer. Okay, poll 3. Homes are forced savings and fund your retirement.
This one seems to be not as overwhelming, but it's around 66% no and 34% yes.
Okay, so here's my take. Homes, we've already established, over time will appreciate. However, when you sell your house at some point in your life down the road, you're going to have to live somewhere else. And as much as your house is appreciated, so has any downsize that you may want to go to. And on top of that, you know, you have to think about that, you know, you want to make sure that you have more money than just your house. So I'm saying, yes, houses can be for savings, and yes, they can contribute to your retirement. They shouldn't be the only thing in your plan. You should be looking at other ways to build wealth besides houses.
Yeah, Terry,
then- yes.
I could jump in here too. I mean,
Sure.
from the bank's perspective, we always say you don't want to be house rich and, bank account poor, right?
Right.
The bottom line is what matters most is what makes sense to the individual, buyer or client. But you want to have a mix of both and definitely not be house rich and bank account poor.
Yeah, for sure. Okay, and the last one. Buying is a better choice than renting.
Good question.
And rather a timely one, given how expensive homes have got and how much renting is now an option or may have to be an option for people.
Sure is.
Now, Terry, this has probably been our closest poll. It's around 54% for no and 46% for yes.
Okay, so this is something that has been very pervasive in our society for a long time, especially people my age who've told their kids that, you got to buy a house, you got to buy a house. You go to school, you get a job, you buy a house. But really and truly, it depends on the kind of lifestyle that you want. It depends on what your goals and your values are. Not everybody sees house as something that's really all that important anymore. Certainly, if you don't know where you're going to be living, especially if you're a new alumni and you just recently graduated, you don't know where you might get a job. You may not know where you're going to end up. You may take a job only for a couple of years, knowing full well you want to do other things. So, like I said, it takes a lot of time to recoup the costs associated with buying a house. So if you don't have a long timeline, I still think it's also better to look at renting. Save your money while you're renting. Now, there's two things I'd like to leave with you, and I should have told you, Ian, I'm sorry. I was going to have you put it in the chat. There is two articles that I think, if you really seriously want to think about this and read about it, there is a man named Preet, P-R-E-E-T, Banjari, B-A-N-J-A-R-E-E. He has a blog. He's a PhD in the psychology of money. Well, he's a PhD in psychology. He's looking at the psychology of money and financial behavior. He has a great blog called, I always forget what it's called, Bonds Are for Losers. And, and he has a rent versus buy calculator. And I suggest you guys look at that. He really makes a very good case that you can build wealth without having to own a home. It may not be quite as good as maybe a house could do it if you hold your house long enough, but it's still very clear that you can build wealth. And the second article is one that's in Money Sense, really a great magazine, Money Sense. I think you can see it, moneysense.ca. It's an article written by someone named Lauren Haw, H-A-W. She wrote it September 2020, and she also looks at the pros and cons of renting versus buying. And I think someone who's really thinking about this should take a look at these two articles and make a decision which, what one works best for you. Okay, thanks for doing the poll. Glad that you're responding. Thank you. Now we're going to go on. Oh, it's down here. Sorry. Oop. Okay, so we just did our house myths. We're going to look at affordability criteria, Manulife's 3-step process, getting ready to buy, financing options, tax incentives for first-time buyers, common mistakes new home buyers make, and then the Q&A. So we did the poll, the house myths were the poll. So what can I afford? So you know what, this is your best place to start. Go to your financial institution or your mortgage broker and get pre-approved before you start. Pre-approval means that the lender is going to talk to you about, is going to look over your finances and basically give you an idea of the range where they're prepared to lend you money, and hopefully they'll also be able to tell you the interest charge that they will, the interest rate, sorry, they'll be charging you. Most pre-approvals that I've looked at in the banks are generally good for 4 months, so it gives you time to be pre-approved and then go for your search. The lender is going to look at 5 essential things, which I'll just touch on in a moment. And really important, I have given Ian a checklist. It's about 30 questions that you need to think about before you take the plunge. And if you have a partner, I think really important that you talk about it with, sorry guys, it's my dog. you talk about it with your partner, and you discuss some of these things, because these are really about what you value, how you want to use your money, talks a little bit about what your relationship is like with money, and really an important talk to have with your partner. Okay, I'm going to turn this over to Joanne.
Okay, thank you so much, Terry. Okay, so yeah, let's talk about what this process looks like. So if you were ready to make that purchase, or you're looking, the pre-approval, as Terry mentioned, is probably the most important thing that you can be doing in advance. So I'm going to walk you through what our process looks like at the bank, and hopefully this will help some of you along, when you're making these decisions. So it's kind of a three-step process. The first one is about the pre-approval, which, again, to Terry's point, if there's going to be anything you're going to do in advance, it's going to be this. So what does this look like? Well, first and foremost, this is going to align your down payment and your income to really retrofit the home that you're going to buy, right? So what can you afford? What can you put an offer in for based on your income? Anytime you're doing a pre-approval, it's really going to reduce any surprises that can come along, such as credit issues, income qualification. And Terry makes a good point. If you're going into this with a spouse or a partner, you're going to hope that there's no surprises, but I assure you, in our experience, there's always something on the credit score that either maybe you forgot about it, maybe it was there for years and you didn't realize it wasn't resolved, or your partner didn't mention something. This is going to really alleviate anything that you're going to have to do, when the time comes to be putting in an offer. So you want to take care of any of these surprises up front. This also allows you to jump ahead in the mortgage approval process, right? So really, it's about just being prepared. The more you can do before, the better off you're going to be when and if the time comes to make that offer. So that's step one. Step two, this is the fun part. Now you're ready to go home shopping. You've done your pre-approval. You know what your income is. You know what you've been approved for, what you can afford. Now you're going to go and start looking, whether it's on, MLS. In this environment, a lot of the open houses are now virtual. But I could give you my personal experience on how all of that works. We went through a home sale back in July. And even though it was all virtual, we sold within 4 days. It was all good. So it does happen, and it is possible. Then when you find a home, you're ready to make that offer, right? And when you're making that offer, this is going to require some kind of a deposit. The question we get asked all the time is, well, how much is that deposit going to be? And the answer here really is, it's going to depend. I've seen offers as low as $5,000, and I've seen offers that can go up as high as $100,000. Now, do you have to make a $100,000 deposit? Sorry, I meant deposit. You don't have to go that high, but oftentimes, if there's, for example, a bidding war, the individuals that put in a higher deposit show a stronger case. So I'll just kind of leave it there. And again, you need to decide what's going to make most sense for you in your scenario. Some of you may have heard of a conditional offer. So what does that mean? Well, a conditional offer is really an offer that's put in with some type of stipulation, meaning, you sign an offer over and you say it's based on condition of maybe financing is one. Now, if you go back to step one here, if you've done a pre-approval, you can actually alleviate that condition of financing because you've already gone through that process. So you're already going to get pre-approved for a certain amount. That strengthens your offer here. Another condition can be inspection, right? That gets thrown in a lot. So you're signing over an offer, you say, it's based on an inspection. You want somebody to come in and inspect the home to make sure that there's no asbestos or really any hidden surprises that you might find with this house. The condition really is there to protect you as the potential buyer, okay? So now what? So you've gone through step two. Let's move over to step three. So now we're talking about the formal approval and the legal work, right? So let's assume step three, you've put in an offer, it's now been approved and accepted, and you're ready to move forward. So what does that look like on our end here? Well, once these appraisal documents are submitted to us, to the bank, so let me go back for a second. If you've done the pre-approval, you've spoken to one of our mortgage specialists, you had some kind of preliminary documentation. Now you're ready to move forward. Your offer's been accepted. So now we want the formal documentations. All of that gets submitted to us, to your mortgage specialist. You sign over the paperwork based on the agreement, and then also based on the type of mortgage program that you were pre-approved for. We have several different types of mortgages, so that's all going to depend on your specific situation. That's sent in, to our internal audit department. We then in turn send those formal documents over to your lawyer, and the lawyer is going to start preparing all of those documents for your closing date, right? So that, depending on when that is, we get all of that ready, send it over to the lawyer. That whole process is what we call instructing, okay? And really it's meant for us to have the time to do all the paperwork, get it back to your lawyer, have it all ready to go for when your closing date comes, because that's really the legal official date when the keys are given. So your lawyer's office takes over the file, and on that particular day of closing, our mortgage specialist will call you as a client and advise that all of the stuff is done and it's ready now to be advanced. And the day comes when you are now the owner of the home and you receive your key. So that's kind of overall high level of what the steps on our end look like. Terry, over to you.
Great. So I'm just going to go back to just talk a little bit more on the approval process, and not so much the approval like Joanne just said, but really what a financial institution might actually look for when they're trying to assess how much money they should give you. And it's often called the 5 C's of credit, and I'm just going to run through them. I could talk a lot about all these topics. I'm going to just highlight them. If you'd like to understand it more, please ask a question at the end. So they're going to look at capacity. That's your debt to income ratio. And I'm going to talk specifically about what they look at to assess your debt to income, because there's 2 particular things that they're looking specifically for. Capital. If you can come up with a good down payment, you've got the deposit ready, those kinds of things, that indicates to a financial institution that you've taken this very seriously, you've saved some money, you've done a lot of thinking about it, you've got the capital, at least as much as capital as you can get together, you've got it together. Collateral, when you buy something, and it's not just for homes, everyone, this is for cars or anything else. When you go to get a loan from a financial institution, if you can provide them with collateral, and collateral is something that you pledge to that financial institution, and if you don't pay, they have the legal right to go and take your pledge and take that and repossess that particular item that you put up as collateral. So obviously in a mortgage, the collateral is a house.
Right, I was going to say that, Terry. Yeah.
So it's a house. If you were getting a car loan, it could possibly be a car. But the thing that's good about having collateral is it generally makes interest rates cheaper, because there's less risk for a lender when they know they've got something that they can go back to and get money from if you don't pay the contractual amount. And the other one, conditions. They will also look at the conditions. So they're going to look at the market. What's going on in the housing market right now? What's going on with the economy? What's going on with interest rates? So there is a global look at the conditions, what's going on in the area particularly that you bought. You know, they want to know what, if you've paid way more for a house that would be comparable in the same area, they're going to have a problem with that if you've overpaid possibly. So they're going to look at the conditions. And the last thing, and the one that you really have a lot of control over and that you need to be looking at maybe even before you get approved, pre-approval, is how is your credit rating? How is your credit scores? It's all part of something called a credit report. I do a whole session on how to build a good credit report. We're looking at, how well you pay on time, your debt to income ratios. It's a very important aspect what creditors make determinations on when they're going to lend you money. So if you need more information, contact me and I'll help you with understanding your credit score and a report. Okay, so going back to that part about, the debt to income ratio. So they look at these two things called the gross debt service ratio, and that's the GDSR. And what they do is they look at your monthly housing cost. So they're going to look at your principal and the interest, so the mortgage payment, the taxes you have to pay, and the heating costs. And that amount of money should not be over 39% of your gross income. And there are some new rules out, and I'm going to talk about CMHC, the Canada Mortgage and Housing. Oh, I wrote it wrong. CMHC, Canadian Mortgage Housing Corporation. They even want it to be lower, 35%. And the other thing they look at is called the total debt service ratio, TDSR. It's also based on gross income, and they're looking at not only your housing costs that we just talked about, but they're going to look at any other debt payments that you have. So if you have lines of credits, car loans, credit cards, anything where there's a debt associated, they're going to add up all your debt plus the house, and that should not exceed 44% of your total income, or under Canada Mortgage and Housing, 42%. And then again, they're going to look at that credit score, what I was just talking about, your credit worthiness. Some financial institutions may go to a score of 600. Basically, I think the vast majority are going to look at a 680 score. The score goes from 300 to 900 generally, and 680 is good score. And obviously the higher you go, so the higher the number, the better the score. If you were coming in at the 750 credit score, the banks would probably, or the financial institutions would probably like you more. Okay.
Terry, I'll jump in here too, just to kind of give, so at Manulife Bank, our baseline is usually the 680 mark as well. Now, we are flexible depending on the mortgage product, so just kind of take that for what it's worth, but Terry's point is right, the higher the better. And I'll just mention here, because we often get questions on how can I find my credit score. There's two places. There's which you can always, you have a right to request. One is Equifax, and the other one is TransUnion. If you connect with any one of those organizations, you can request what they call the credit bureau, and that should give you what your current score is. Just keeping in mind, the more you request that, the lower the rate goes. So you don't want to be asking for that too many times. I think a general rule is maybe once a year, gives you a good idea.
One of the things that we can say around that, because when you do ask for a credit score, actually, Joanne, my understanding, just to be clear, I think, is that you can access your own as much as you can without losing points. But if you go to a lender and you are asking for a lender to make a determination about your risk and whether they should lend you money, every time you use that, it can lower your score. So for people who are looking for for mortgages, what you should do, and the way the rules are for the credit bureaus, Equifax and TransUnion, is that if you look in a very short period of time, like maybe 3 to 4 weeks, and do all your talking and comparing rates between different financial institutions, if you do a whole bunch in a very short period of time, you'll only be considered as having one on your credit rating, on your credit score. So, if you look now and then you decide I'm not going to do it, and then you're going to look again 3 months later, you're going to have, every time you do it longer than a short period of time, you're going to keep getting hits. And every time you get a hit on your bureau, you're going to lose some points on your score. So be mindful of that. Okay, so you're ready to buy. So tip number one, and this is, I think, important, and I know that Manulife has one, so I think that's on a later slide of yours, Joanne. But I didn't know that Manulife had it. So when I wrote this, it was one place that I use a lot is the Globe and Mail. The Globe and Mail has a writer called Rob Carrick. He writes a personal finance column, and he has a blog for millennials specifically. They have a lot of really great apps on their website. And one of them is called Know Your Real Life Ratio. And it will help you take a look at not just the TDS and the TDSR and the GDSR, which is what the banks really spend a lot of time on. They will look at really lifestyle stuff. How much do you want to travel? How much, how many kids do you have? Are you facing braces? Do you have a special needs child that costs a lot of extra money? And that will help you really determine how accurately or how accurate you should be in really knowing what you can afford. Okay, so tip number 2. I say you need to take a look at your costs and what all this house is going to cost you, because costs are housing costs more than just the price that you're going to pay for the house. So I say look at sort of 2 budgets, or at least 2 areas that you have to think about in terms of what the costs are. So budget number 1 is the cost of buying and closing the deal. And the second one is what's your lifestyle budget? You know, how do you really want to live your life? Okay, so let's take a look at the budget number 1. These are all the costs that you might incur or will incur probably when you go to close. So you will need a down payment. And the minimum for most financial institutions is you need at least as a minimum a 5% down payment. You will incur mortgage insurance, which I'm going to talk to you in a moment about at length. You will have legal fees, and not only do you have to pay for the lawyer and their costs, but you will have to pay for anything that they've ended up spending on your behalf. So if they make phone calls, faxes, emails, paper, stamps, like you name it, you're paying for it if they've had to use it for your house.
Terry, can I just jump in for 1 second here?
Yeah, sure.
I just want to make a point, and a reference right here is Manulife Bank covers all legal and appraisal fees for first-time home buyers.
Oh, so that is fantastic. There's a real good reason to look at Manulife, boy, because this can be quite costly.
Yeah,
quite costly. Then there's land transfer costs. Again, I'm going to come back and tell you what that is. Some people may not realize when they buy a house, if they've got a house that had utilities and taxes particularly paid for in advance by the previous owner. So let's say they had a $3,000 tax bill and they paid it up front, and they've only lived there now before they sold it to you for maybe 2/3 of the year, but they paid all $3,000, you are going to have to pay them back that last third that they paid. So you're going to get a cost of $1,000 added on to your house. Now, it will mean that your taxes are paid for the rest of the year, but you're going to have to come up with that money on closing. The same can happen with rental equipment. The same thing could happen with utilities. So make sure that you're very aware of what has been paid before and what liability you may have when you close. You can get a home inspection, and that's a fee. You can get title insurance. There will be property insurance. You will need to show your financial institution that you have insurance, or they will not give you a mortgage. There'll be moving costs. And just one thing that happened to me that I didn't realize, there are some things that could be in your house that an insurance company does not want to insure. So I bought a rental property. It was old. It had knob and tube wiring. When the insurance company found out it had knob and tube, they were saying, okay, you've been a really good client, Terry, for a number of years, so we're going to do it, but we give you 2 months. And at the end of 2 months, that knob and tube has to be out and your house has to be rewired. Well, that was thousands of dollars to rewire. I don't think that happens lots, but it could. So be aware of maintenance costs and renos that need to be done because you have to, or because you just want to before you move in. Make sure you have that money. And all this, there's always setup fees for your utilities and whatnot. So those are the things that you need to be mindful of on closing. And I'm just going to take a few minutes to talk about mortgage insurance. If you are going to pay with less than 20% as a down payment, you will need mortgage insurance. And this mortgage insurance basically is something you pay, but it's really protecting the financial institution. They're taking a risk. And if for some reason you cannot continue your payments on the house and you can't pay the mortgage, then this mortgage insurance kicks in to the lender. It's a little bit, okay. So the buyer, you pay the premium, and that premium is actually rolled into the mortgage. So you don't have to come up with a big amount of money. That just gets added to your mortgage. But there is a GST cost on your premium, and that is due on closing. So that GST cost does not get rolled in to the mortgage. So you have to, that's another actual cost actually at closing, the GST on if you don't have 20% down as a down payment. The big companies that provide mortgage insurance, the 2 biggest ones that I'm aware of, and Joanne may know more, Canada Mortgage and Housing Corporation is the government It's the biggest one that I'm aware of, and Genworth is a more private company, and they cover the difference between the down payment and what you were able to give as a down payment and the 20% that the financial institutions would like to see. And so you're paying for that that differential. And if you want more information about this stuff, I really like Canada Mortgage and Housing's website, incredibly good website. And they have a calculator there, and you can actually plug in the amount of money of your house, and you can see what your the mortgage loan insurance and the premium will be. Okay.
Terry, let me just jump in here if I may for a moment.
Yeah, absolutely.
I know we talked about doing the Q&A at the end, but some of the pre-questions that came in, one of them was the insurance. And I'll speak to this for just a minute, because we also do have at Manulife a different type of insurance that we call CGI. It's called CGI, stands for Creditor Group Insurance. I just want to make people aware of really the differences, because you touched on, you know, when you say the amount is rolled into the mortgage, what I think people need to understand is that amount gets rolled into the life, which means it gets compounded throughout. So in other words, you're paying interest on top of that. Now, and what's really important here is you have to read the fine print, you have to know what questions to ask, and you really need to do your homework. The mortgage insurance that we offer, well, let me back up for a second. The typical insurance that's offered at other banks or other financial institutions is what they call post-claim underwriting insurance. So in other words, they sign you up, and then when you have a claim, you know, if and when there's a claim, is when they see, you know, that's when they see if you qualify, right? We know, we've done research on then, as a result of this, about 80, I think the number is about 80% of those post-claim requests are denied, right? And most typical insurance typically has what they call a level premium, right, with declining benefits. That means, let's say your mortgage is $200,000, your premium is, I don't know, $50. Your premium never goes down, no matter how much you pay off of that mortgage. So you can have a mortgage of $10, but that level premium is going to continue to be $50 for the life of that mortgage. So that's really something you need to pay a lot of attention to. The CGI insurance that we offer is a little bit different, because we underwrite it at the time based on the application, and our premium actually, or your premium, fluctuates with your balance. So as your balance comes down, so does that premium. So you're not paying that continual level set premium over, you know, 15, 20 years amortization. So we can offer more information on that. I just want to make that clear. And since we're talking about insurance here, I just wanted to jump in and talk a little bit about the insurance that we offer at Manulife Bank.
Yeah, no problem. Information is important. The more they can get,
absolutely. Knowledge is power.
Yeah, absolutely. The other thing that you may not know about is something called land transfer fees. That is a provincial tax. It varies from province to province. So if you're thinking about moving out of Ontario, you'll certainly have to do your homework to find out what the tax is in the province you're moving to. What it basically does, I'm going to talk now specifically about Ontario. So what the Ontario government did is they said, as houses prices have gone so high and they want first-time buyers to be able to get into the market, there is a refund that you can get. Not really a refund, you don't get the money, but it's a deduction off the amount of the total land transfer tax you have to pay. So when your lawyer goes and actually registers, you know, that your house as yours, it'll be based on the price of your house, there will be a land transfer tax. But if your house is really high price, there's going to be a maximum. They'll only refund you sort of $4,000. If your house is a little bit less expensive house, if it's like, say, you know, your land transfer tax is $3,500, they'll give you the $3,500. But there's a maximum. I just want you to know, if your house is more expensive, it could be more than the $4,000 refund that the province is offering you. So there is a max at $4,000. You don't have to do anything. It's all done by your lawyer. So if you knew that based on the price of your house, you had a $7,000 land transfer tax, you know, at closing, you'd only be paying the difference, the $3,000. So $7,000 minus the $4,000 that the government will carry, and you'll pay $3,000. Okay, so and if you're thinking about buying in the GTA, the City of Toronto, the municipality, has actually added on their own land transfer tax. So not only do you pay the provincial portion, you pay the municipal portion, and land transfer tax in Toronto will blow your mind, right,
Yeah.
Joanne?
Terry, I can speak to that first. I live right in the GTA, and depending on the value of a property here, you could be paying land transfer, in and around the 60 to 70 plus $1,000, which is a big chunk of money, when you're really trying to budget for something you can truly afford. So again, you need to make sure that you're identifying with all of the parameters and just make yourself knowledgeable of what really is out there. But yes, in the GTA, it's almost a double tax, Terry, isn't it?
It is. It's almost like a double tax. It's pretty
Yeah.
brutal. Yeah.
Yes,
So
it
be
is.
aware of where you live. Okay, budget number 2, then the next thing that I would be doing is just making sure that you take a look at your day-to-day expenses, the stuff that you do on a regular basis, food, entertainment, debt, clothing, grooming, healthcare, all the things that you find important to maintain your lifestyle, and make sure that there's some money hopefully in there for an emergency fund, because I think an emergency fund is as critical as making sure you're paying, your mortgage payment. And so if your new mortgage and your new principal and interest charges and these expenses associated with your house, you can do it, then you can feel more comfortable that you haven't overbought. If you're really interested in doing budgets with me, again, you can go on Oscar Plus, book an appointment with me. I can see alumni and I'll help you look at a budget, whether, what you can afford. Okay? Joanne.
Yeah, absolutely. Thanks, Terry. So Terry mentioned a bunch of, a bunch of different calculators. There's so many different variables that you can, or ways that these calculators vary. We've got a few that they are on our public website on manulifebank.ca. This one here, I thought this was a good one. I kind of call this one the KYS, Know Yourself. And it's really just I didn't do the whole calculator here. There's another page, but just for the space variance, I just kind of did the first few questions. But it's about really just giving yourself a true assessment, going through and checking the boxes that really apply to you, so that at the end of the day, you come out with a really true understanding of what you can afford, what you're comfortable with. And I think it's just a really good practice to write a lot of this stuff down, right? So many of you may recall, if you've ever gone into a financial institution and they're asking you about your risk aversion, how comfortable are you investing in the market? This is the same type of idea, right? And it gives you, it doesn't really spit out a score, but it gives you an idea of what your tolerance is based on your expenses and what your comfort levels are. So this is one example. We've got another one, a debt calculator, and they're all on manulifebank.ca.
Okay, good. You want to talk about this too, right, Joanne?
Absolutely, yeah. So, what are financing options? I don't know if I'm going to make an assumption that many of you have heard of the term fixed rate mortgage, variable rate mortgage. These are the typical sort of scenarios that you're going to come across when you're talking about mortgage payment options, right? And really, what it comes down to is the amount of interest that's being paid over time. So the fixed rate mortgage, as you see here, is exactly kind of what it says. Your monthly rate is a fixed amount based on an interest variable. So people typically will go with a fixed rate mortgage because they're comfortable with a certain payment. They budget it into their, whether it's monthly, or actually majority of Canadians pay their mortgage payment, make their mortgage payments every 2 weeks because they align with how we get paid, right? But for the most part, anybody doing a fixed rate mortgage is comfortable with knowing that this $500 is what's going to come out of my bank account every month. I know that that's going to be off my income, and I'm comfortable with that. And typically, fixed rate mortgage rates are a little bit lower than variable. Variable rate mortgage is exactly what it says here. They change with your prime lending rate. So whatever the Bank of Canada rate is, these change according to that. The benefit of doing this, of doing the variable rate mortgage, is if rates go down, then you can take advantage of that lower rate, right? The flip side is if rates go up, then you're paying a higher rate. But what the variable rate mortgage option gives you is that flexibility to lock in if you feel the rates are starting to really go up, which hasn't happened in a very long time. But if they do, you have the option of locking in. Variable rate mortgages are usually a little bit more expensive. The rate's a little bit higher because that built-in flexibility costs a little bit more. But again, it really all depends on your personal, I'd say the bottom line here is it depends on your personal situation. What are you most comfortable with? And we at Manulife Bank, we could talk about, you know, all of these options that pertain to you and your personal circumstances.
Okay. Okay, so let's talk a little bit about tax incentives. There's 3 of them that I want to touch on. The first one is the first year that you buy your house, the year that you're filing your taxes for that. Let me start again. When you buy a house, the year that you're buying it in, that's the year that you'll be doing your taxes for. So if you bought it in 2019, in 2020, you'll be filing your 2019 tax return. So on that year, you will be able to tell the government that you bought a new house, and they will give you what we call a $5,000 non-refundable tax credit. And what that basically means, tax credits are always based on a formula. It's usually 15% of whatever the amount is, the actual tax credit is. So 15% of a $5,000 income tax credit is actually $750. So if you had to pay $1,000 that year and you were able to use your tax credit, you would get a $750 tax relief, and you wouldn't have to pay the $1,000 to them. You'd only have to pay $250. So it's actually what comes off the tax that you have payable. So it's not $5,000 that comes off the tax available. It's the credit itself, the 15%, which is $750 of $5,000. Okay, now that's the home buyer tax credit. Then there's a home buyer's plan. And that's wonderful if you've been able to have an RSP, or if your partner, whoever you're buying the house with, has an RSP. Both of you can use up to $35,000 in your RSP, and you can put it towards your payment for your house. The thing is, you must pay that money back over the next 15 years. You have to pay 1/15 of it each year. And I don't believe you have to start paying it back until you bought a house for the second year. So you've got 2 years to start making that payment back to the RSP. But you know, it's been great if you've been saving and trying to get the tax break of an RSP. You can turn around and then use that money to buy a house. So that's a very good program, and both of you can do it. So if you had 2 people, that could possibly be up to $70,000.
And Terry, that's just so that we're clear, that's a loan. You're essentially taking a loan on yourself, but you're not paying any interest on it. Is that correct?
No, you're not paying any interest. You just have to pay back the actual amount that you took out, up to $35,000. You just have to replace it, because if you don't replace it, you got a tax credit when you filed your taxes based on what you put in the RSP. If you don't start to pay it back, then all of a sudden that money will get, if you don't make that 1/15 of a payment, that amount gets added onto your income that year, and you're going to pay the tax at that point. So if you want to avoid paying tax on what you took out of your RSP, which is tax sheltered,
You need to pay that back.
you need to make that 1/15 payment over the next 15. You can obviously pay more than 1/15, but you have to pay the 1/15.
For me, I'll just say this. When I bought my first home many years ago now, if it wasn't for my RRSP savings, I wouldn't have had that opportunity to sort of catapult into that new category for me. So it's you know, pay yourself first, make those, you know, savings matter for you. And like I said, for me, it was the only way that I was able to become a first-time home buyer many yeurs ago.
Yeah, it's really a program worth absolutely
program.
tapping into. Okay, the last one I want to talk about is something that the Canada Mortgage and Housing Corporation, CMHC, has made available to first-time home buyers. And it's really there to help first-time home buyers actually be able to afford a home when they are aware that home prices are going up so much. So how this helps you is they basically give you they actually end up sort of co-owning a part of your house because they're actually going to give you money towards your down payment. You have to have at least 5% of your own money, but then they will come in and add to it. And I'm not sure, are you, how much they add to it, Joanne?
I'm not familiar with the program, to be honest with you, Terry.
You know what?
Don't know.
Yeah, you know what, you'll have to, some of you, if you're interested in this program, there are a lot of rules and regulations around it. You have to be a first-time home buyer. You have to have the 5%. What happens is this money is given to you. It will make your payments each month smaller because now you'll have a bigger down payment. So you'll have to borrow less from the financial institution. And of course, because you'll have a bigger down payment, you also won't have as big a mortgage insurance cost as well. So it is a good help, but it does have rules and regulations. When you go and you sell your house down the road, you will have to pay back the Canada Mortgage and Housing Corporations for the money that they gave you for this down payment. So it's not a gift to you. It is a interest-free loan that helps you buy, that, you know, gives you some advantages so that you can buy. And when you sell your house, you will give them back the money. If your house really appreciates, then they get part of that appreciation. If your house actually loses money, then they don't get all their money back. So they're not, it's a percentage, and so it's pretty fair. The thing is, it's got regulations around how much the house can be that you're buying, and there's regulations around what the total income of you, and if you buy with a partner, what your partner's is. So I do suggest that you Google the first-time homebuyer program if you're interested in it, and just spend some time reading about it and really get a handle. You know, depending on your real estate broker, some of them are very knowledgeable about this program. They may be able to help you as well.
Yeah, Terry, I was going to say a good real estate agent should be able to help a buyer with a lot of this information.
Yeah, but you know what? It's very important that you have a good, knowledgeable real estate agent. So, and actually that's one of the common mistakes that I see, is that you go do this and you don't have your team in place. And it's important that you have your, you know, you've talked with your financial or financial institution or your mortgage broker, that you have a lawyer in. One of the things when you actually buy your house and you put the offer in, they will ask you, who is your lawyer? Like, you need to know that. You may want to have a home inspector standing by. So it's really important that you do your homework, you do your due diligence about these particular team of professionals that you need. And some people go in and they're just so to the wire. There's no extra money if something goes wrong. So please give yourself a bit of an emergency fund or little cushion, whatever you want to call it. Make sure you know your costs. Do budget 1 and do budget 2. Another mistake is they don't get that pre-approval and they start looking at homes and they get so excited about something, and then they realize that they aren't affordable, and it's very disappointing. So no, don't go looking at homes that aren't realistic for you. That would be sad. And Joanne did mention that there is a deposit. I've written here substantial down payment. I don't mean a down payment, I mean a deposit. So when you are, just like Joanne said, when your offer of buying a home is accepted, there will be a deposit. She's absolutely right. Some of them can get incredibly high, the deposit, and it's a way to maybe make your offer more favorable, but generally they're between the $10,000 and $20,000 amount that you need to come up with on acceptance of an offer. Okay.
And Terry, I'll just mention here very quickly, I forgot to mention this before, but and again, a good real estate agent will tell you this, but a deposit, when you're ready to make an offer, a deposit needs to be sometimes either guaranteed funds, like a certified check or a bank draft. It's a small minor detail, but you'd be surprised how many people miss that. And timing is usually of the essence when there's, 4 to 5 offers coming in. You need to know that your deposit needs to be a certified check, which usually requires a call to your bank.
Right. And yeah, right, exactly. That's really true. You know what, the thing that's going on right now in Hamilton, for sure, multiple offers almost on every sale. You have to be able to have this stuff at your fingertips, because you don't have time to go find a bank or, find, a home inspector. Okay, so I'm just going to give you a quick example of how this might work on for closing costs. So you buy a house for $399,000 and you have a 5% down payment. That equals $19,050. The interest rate, don't worry about it, I just wrote it in. So actually, that would be a very high interest rate given what's going on with
Probably lower now. Yeah.
much, much lower now.
You're
I
right.
did this a while ago, but the example is still relevant, just the interest rate's wrong. So given the fact that you purchased it, you gave them a down payment, your net amount now is $379,050. Now, you only had 5%. So you have to have financing. You have to have this mortgage insurance financing. And I use Canada Mortgage and Housing. There's other ones, obviously. So, so you are financing your house with the bank. The financial institution is giving you 95% on a chart that you can see if you just Google the mortgage insurance amounts. At 95%, you have to pay 4% of the amount that you're actually borrowing from your financial institution. So in this example, 4% of $379,050 is $15,162. That amount is added to your net amount. Okay, so your mortgage payment, what you're borrowing from your financial institution is the $379,000 after your down payment, plus adding on the $15,162. That is for the mortgage insurance. Whatever. Uh-oh.
The other way.
Oh.
One back.
Oh, here it is. Okay. Then I said all the other expenses. So the land transfer in this particular example would be the land transfer based on the price of the house is $4,460. You're getting $4,000 from the provincial government when you register. So you'll only have to pay $460 out of your own pocket. If you get a home inspection, it's around this price. It could be more or less. It's often geared to the price of your house as well. Title insurance, that just makes sure that you get that what you're buying is clearly yours, and if there's any liens on the property or encroachments on your property and they don't know, your lawyer doesn't pick it up, and there's a problem, the title insurance will help you fight the issue. And now, title insurance, I have to tell you, is not mandatory in Ontario, but I think most lawyers are going to recommend that you buy the title insurance. The legal costs, if you don't use Manulife, it's around this amount. It could be somewhere around here. The GST on that $19,000 that you had to, or whatever, $15,000 that you had to pay for your mortgage insurance. Remember I told you the mortgage insurance cost gets rolled into your mortgage, but there's a GST cost that has to be paid at closing. So that GST cost is $1,971 for that house insurance. So the total cost of these expenses is $4,572. So in total, you bought your house for $399. You had to put down $15,000 for the house insurance, and you had to have these other expenses to buy. So altogether, your house has cost you basically $418,734. So you can see that these extra costs, that was almost another $19,000 more than what you thought you were buying the house for. And you have to come up with that money on closing. Okay, so that's basically, oh no, you have something, Joanne, sorry, you have another.
Yeah, no, not to worry at all, Terry, thank you. And I mean, hopefully all of this information doesn't make buying a home for the first time a daunting experience. I could tell you my personal experience. I've owned several throughout my lifetime. I think it's the most rewarding experience to have that opportunity to own. Now, because you guys are all, or everybody on the call is a McMaster alumni, I mentioned a couple things. We automatically cover the legal and the appraisal fees for all of our mortgage clients. So that could be upwards of $2,000. But in addition to that, as an alumni, we also provide some exclusive offers to you folks as well. The first one is, if you come to us for a mortgage, you get approved, it's funded, we will give you $1,000 cash back to go right into that debt immediately. So if you've borrowed 200,000, we'll knock off 1,000 off of that amount, put that right back into your account. So we give you immediate mortgage reduction from the get-go, which is a huge amount. I don't know that there's any bank right now that will offer you $1,000 cash back. If you're not really ready to do a mortgage yet, and we're here for you when you are, but if you're not ready to go down that path just yet, we also have a deposit account. It's what we call our Advantage account. It's an online checking savings account. And again, exclusive to McMaster alumni, this account pays a bonus rate of 2.25% for the first 4 months. Now, if you think about it, think back to where your checking account is, at your bank now. There are not very many checking accounts that are paying anything above 0% right now. Ours offers a 2.25% bonus rate for alumni. Use it as a savings, use it as maybe a forced type of savings account. We talked a lot about that today in Terry's presentation. So this is some ways in which you could take advantage of some of these perks that are available to you as alumni. You'll see and I think Ian's going to send everybody a copy of this deck. You'll see the link at the very bottom there. If you click that, it'll take you right to this landing page that you see here, where you can, find out more information. No obligation, no cost. If you want to speak to somebody on our team, we could definitely walk you through some of these platforms, whether it's the calculators or even just really to answer any of your general questions.
Okay, so we are done our presentation.
Formal component, yeah.
So I'm wondering, Joanne, should we look at the Q&As that are coming up from here
Yeah.
first?
Why don't we do that? There's a lot of really great questions. Some may have been covered. We'll do our best to try to go through as many of these. We can certainly pick through the ones that are coming in live, but then we also had quite a few that were sent in advance, and some of them are really good questions. So we could probably touch on those also. So I'll start, Terry, if I may. Maybe I'll just start with the first.
Yeah, why don't we go back and forth?
Anonymous attendee. It's okay, they don't want to give us your name. That's all good. So the first question is, what should I budget for home maintenance? Does the 1% of the home value rule of thumb, oops, where did that question go?
Where did that go?
I don't know. I lost it. Basically, the question was, does the 1% rule of thumb apply? I think it was to the value of the home, to factor in, I guess, for costs or all-encompassing, maintenance fees. I think you covered some of that, Terry. I don't know that I've heard, I could speak to I don't know that I've heard 1%. For me, my experience, I would say absolutely go through the calculator. From our perspective, that's what really helps you kind of get to a more definitive number on what those costs are gonna be for you. Terry, I don't know if you have any comments on that, or
not really, because I think it's very specific to your house too. What if you buy a 100-year-old house versus a brand new one? If you have a brand new house, I don't imagine there'll be a whole lot of maintenance to it. But as you get older homes or buy ones that, may have they were cheaper, but it means that you're going to have to do some home improvement. So I never heard of 1% either. I think you just have to know sort of how well your house has been built, how old is it, hopefully your home inspector has been able to give you some indication of what you might be facing. Is your furnace due in 2 years or 5 years? What about your roof? Are your windows new? So I don't know. To me, it's a very specific to your house question that it is.
It really is. Yeah, I would agree. Okay.
Clarification, does CMHC and Genworth cover the GST? No, that is your cost. You are paying the cost, the GST, on the total amount that you had to also pay the mortgage insurance companies. So no, that's your cost on closing.
Okay. Is it possible that you put 20% down and still have to pay, the CMHC mortgage fees that we talked about? No, it's a hard sort of number where anything over and above that is covered through the bank.
Yeah, I should say that I think it changes if it's $1 million home, but I don't imagine that's a big issue for us right now. Okay. I talk about the idea of buying a cheaper house first and then selling it and buying a more expensive one down the road? Oh, well, that's how I did it. I'm in my fourth house. It took me 3 other houses before I got to the house that I would, I guess, consider my dream home kind of thing.
Absolutely.
Yeah, to me, I would just, I see it as a ladder. You want to start at the bottom rung and work your way up to what you want. I don't think that
Absolutely.
you need to go into the house of your dreams right off the bat. It's fun to build a nest like that and to see you get better and better.
And I would say take pride. And I mean, I might even want to reference another question that came in, Terry, prior. So there was one question that talked about, is it better to buy a semi-detached or wait and save to buy a fully detached? I don't know that there's some might say they love semis. Others might say they would never buy a semi. There's no hard or fast rule there, folks. It's all about what you want to do, what you love. And yeah, get excited about the process of wanting to be a homeowner, whether it's a condo or a townhouse or a semi or a detached. I don't think there's a right answer for any of that. It's all based on what works for you.
Yeah. And what you can afford. I mean,
Right.
if all you can afford is a smaller home and not the area that you necessarily was your, first choice. So get into the market anyway. You'll get there.
You might
your
need
house
to move
will-
out a little bit.
Yeah. Is there a deadline for me to repay the RSP? Yes, you have 15 years to repay the RSP that you took out. That's why I was saying after the second year that you're in the house, you have to start paying 1/15 of that back each year. So you've got 15 years. Well, actually really more like 17 years because they don't expect a payment the first 2 years. They're just letting you get on your feet before they're asking you to start to repay it.
Okay, so I can take this next one. What's the difference between the deposit and the down payment? Actually, I didn't really. So the deposit is, think about when you're going in and making an offer, you have to show up with something. And that's, remember when I talked about having that certified check or that bank draft, right? That's the sort of initial offering to say, I'm interested in putting an offer in this home. The down payment is now let's say your offer was accepted. Your down payment now is going to be the difference between what you are going to be paying versus what the bank is going to lend you, right? So you might have money saved up as a down payment. Maybe your parents are helping you out, whatever the case may be. But that down payment is actually what you are putting towards the purchase price of the home. Now, your deposit is going to be a part of that. You'll never lose that deposit. Best case scenario, your deposit goes towards the purchase price. Worst case scenario, you don't get the home, you're outbid or whatever the case may be, you get that deposit back. And as a matter of fact, I know folks that, sometimes have to give 3 or 4 deposits because they're making offers on many homes. They lose the home, they get the deposit back. So that's the difference between the two.
Yeah, and you'll never actually, until the offer is accepted and you win the house, that is just a check that's sitting there. It's not being taken out of your account. You won't actually see the money come out of your account unless they actually accept your offer at that point. So it's really just a check that basically shows that it's, the money is there if the person wants to accept your offer. Title insurance. How do you buy title insurance? That is just part of the closing costs of your lawyer. Your lawyer takes care of that and it's in her bill or his bill. So you don't do anything. It's just part of the legal fee.
Okay, so I think the next question we answered it. What happens to the deposit during the bidding process? Next question, any tips for finding a lawyer? Terry,
Well, I like to use lawyers that do real estate law. I'm sort of like a bit of a specialist, I mean, you can go to a lawyer and it could be a lawyer who does, wills and suing people and, like to me, I'd rather just go to a lawyer who that's their job. They're often corporate lawyers or they specialize in real estate. They know all the ins and outs. I just like the idea of using a specialist. So I guess I would and talk to friends and family. Maybe your bank might recommend someone. I don't know.
Yeah, we can. I mean, in my experience, we just went with our family lawyer who was very good at doing the paperwork. It wasn't as expensive because that could get costly as well. But yeah, I would maybe ask a referral or maybe your real estate agent might know one if you don't have a specific one. Yeah, good question. Is the deposit a reduction? Is the deposit a reduction to the down payment or something extra? So we touched on that. So if you do eventually, if you do get the house, your deposit comes off the price.
Okay, if you pay more than the 1/15 back into your RSP, do you get tax credits that year? No, you don't get any tax credits for putting that 1/15 back in, because you've already gotten the tax credit when you initially put your RSP money into your RSP. So you got the tax credit maybe, 5-10 years ago. Each year as you can, as your RSP grew, every year that you put money into it, that's the year that you get the tax break. So when you put the money, when you're repaying it back, it's a neutral. It doesn't add to your tax, it doesn't reduce your taxable income at all. It's just, you're just paying it back. Do you understand what I mean by neutral? It has no effect. So if you owed, let's say, $1,000 each year, the 1/15, you'd have to pay $1,000, and that would just go into satisfy the rules. And then if you put in $3,000 or $4,000 more on top of the 1,000 because you still wanted to get a tax break, you would get a tax break on the stuff over and above what the 1/15 payment was. Okay.
Okay, next question. Is it not worth buying a home if you don't know whether you'll be in it for 5 years, even as a first-time home buyer? So, I mean, I could talk to this one a little bit, Terry. You might jump in here too. I don't know, at the bank, we always say that there's this sort of stigma in the industry about this 5-year commitment. And I think a lot of that is because a lot of banks offer mortgages with this 5-year fixed rate. And I would say, and if that's the assumption here, I would say there's no magic number here, folks. I know somebody that bought a house less than a year ago, has already made money, and is already selling it circumstance for that individual. So it absolutely, it's worth it if it's the right decision for you based on everything that we talked about here today. If you can afford it, if you're in the market, and circumstances happen. You may need to sell in 5 years. You may need to sell in 3. But for me, I don't know that there's this, sort of finite number of 5 years that makes a difference. Terry, I don't know if you want to add anything to that.
Yeah, I'll add something to that, because I think the 5 years, part of it is absolutely right, Joanne. Because if you have a 5-year fixed mortgage, you will pay a penalty if you go out of that mortgage. And it could be quite substantial. If interest rates change quite a bit, you'll pay the differential between what the interest rate you're paying and what the new interest rate is. So if interest rates have gone down, you could have quite a big penalty from the financial institution for the fixed mortgage. And then you just saw that your $399,000 house cost you $418,000. So you want to be able to know that your house appreciated at least the $18,000 that it cost you to get into the house, plus if you have a penalty. So I think it's just coming. Listen, houses have been going insane. People have been making, 1 year to the next have been going up 15%. So if that's the case in this market, yeah, you probably don't have to hold a house that long, because house prices are zooming up like I've never seen before. But if you were in a down market and you happen to buy at the peak and you have to sell when the market goes down, there are those these costs that you have had to pay. And if you don't want to lose money and you have control over it, I'd probably stay in the house until at least I broke even. But that's just that's me.
Yeah, now I'm going to add here just for a second. I know we didn't talk a whole lot about product. At Manulife, we have mortgages. We didn't specifically talk about which ones, but we also have what we call an all-in-one account. It's called the Manulife One product. There is no fixed rate, a fixed term. It's a line of credit, open line of credit that doesn't really put you into a fixed term at all. And so that sort of takes away this penalty that we're talking about. Just putting that out there. Again, we're not going to get into that specifics today. We're happy to talk about it for anybody that's interested. But there are ways that you can work around it. You just have to do your homework. That's all.
Yeah, and I do think that it sounds like from what you're talking about, that Manulife has some very more creative ways of financing thing. I'm really talking about sort of mainstream finance.
Yep.
Well, not that Manulife isn't mainstream, but more the big six banks.
Traditional mortgages,
Yeah,
yeah.
conventional. And so, you
Right.
are going to hit this penalty. And if you can bypass that kind of stuff and give yourself that flexibility, then there's a really good reason to be, thinking about alternatives rather than the big sort of conventional banks, right? Or whatever you want to call them. But anyway.
We call them the big five, Terry. It's okay.
The big five. Okay. The big five. Yeah, okay.
It's all good. I think we talked about this one. Does requesting a pre-approval from a bank affect your credit score? The answer is yes. So Terry talked about the more requests you make for applying for a visa or a mortgage, car loan, those are what we call hits against your credit. So that will be affecting your credit score. Yes.
So is it better to have 10% down than 5? Yeah, for sure. Because if you put more money down, then you're going to have less money you have to pay each month, because the mortgage that you're getting from the bank will be less by 5%. So it'll be a smaller mortgage, which means it'll be a smaller monthly payment. And again, you'll pay less money for your mortgage insurance. So the more money that you can have to put down, still making sure that you have money, for some of these emergency sort of things, surprises along the way. Yeah, the more money you can put down, the better.
Absolutely. I love this next question. What happens if you buy a second home before paying off the mortgage from your first home? So Manulife Bank is one of the only banks, if not the only bank, that allows you to do what we call port a mortgage without any penalties. And that simply means doing exactly what this question is asking. You bought a new house, you haven't paid off your existing mortgage yet. We allow you to port that mortgage over and either add on it if you need more. We'll look at your circumstances, but we are one of the only banks in Canada, if not, as I said, the only bank that allows you to do what we call this porting of the mortgage. So if that's a scenario that you're dealing with, please reach out. We're happy to talk to you a little bit further on that. But yeah, that's a great question.
Mm-hmm. I didn't know that either. That's great information. Okay, how do real estate agent costs typically get factored in? And are the buyer, seller, real estate agent commissions bundled into the list price? So very good question. The real estate agents get paid. And the way they get paid is it's not bundled into the price of the house. It's a separate cost over and above. But when you buy a house, you don't pay really any real estate fees. The real estate fees are paid by the seller. Okay, and so whoever sells a house, they're going to lose. Let's say you gave them $400,000, they might actually only get, I'm just making this up, $375,000, or because that the real estate companies will take their money first before they give the person who sold the house their money. They take their money first, and they have a split between who sold the house and who the real estate agent who bought in the buyer and the real estate agent who sold the house. So you don't really have a real estate fee when you buy. Only when you sell.
Yeah. Okay. Would you recommend buying a home if you could only afford a 5% down payment? I mean, we touched upon this one a little bit as before. There's no really right or wrong. It all really depends on, let me just say this, and Terry, you can speak to this as well. Anything less than that 20%, you're paying that CMHC or that additional coverage. So if you're prepared for that and you budgeted for that and you're ready to be a homeowner, whether it's a less expensive condo or a townhouse or whatever, then sure, if that's all you have, then that's all you have. But you've got to analyze your own personal situation, as we've been saying really all along here. So Tara, I don't know if you have any feedback or comments on that.
No, I think that's fair. And I'm actually looking at the next question. Would you take that?
What do the closing costs of pre-construction look like? Are they similar to the example you mentioned here or slightly different? Yeah, we didn't talk about construction or pre-construction here. There are sort of other costs involved. In fact, even the underwriting is a little bit different for a construction loan. I don't have the exact details of what those closing costs look like. Some might be similar, some might be different. But the whole process for what we call a construction loan is a little bit different as far as underwriting than it is when you're buying sort of a traditional, bricks and mortar, right? If this individual, Paneet Sharma, would like to send us an email or send me an email specifically, I could take that offline and get you a more detailed answer to that question. But that's a good question. We didn't talk about that today.
Yeah, and it's not something I know, so I'm glad you're here, and even you need to go look it up. It's just, we haven't really made new construction a priority. Sorry. Next question: is there any reason to search based on price when they are usually bidding wars? Yeah, I feel your pain. I hear you.
Yeah.
It's so frustrating. I've lived in the same house, but I have been part of how, the journey of my children. I have adult children who bought homes. And I know for my daughter, she must have put in about 7 or 8 offers before she finally was successful. And yes, things are going over, and I think you have to be prepared, not only to have everything at your fingertips like we talked about, but also to be prepared that it may take a while before you are able to find a house that you can, even with the competition, you can afford and you can do. It's not easy right now, for sure.
Yeah, and speaking of competition, Tara, I'm looking at the next question. How do you protect yourself when buying a house when adding a condition of inspection effectively disqualifies your offer? It seems like flippers often go in without conditions, which is really hard to compete with. Yeah, and again, feel your pain for sure. It's a tough environment when people are. I don't know if I'd want to be buying a home. Although I did it recently without inspection, but that's only because we tore the house down and built on it, and it didn't really matter what the condition was. But I don't know if I'd be going into a home as a first-time home buyer without having that proper inspection done, because we talked a whole lot about these hidden costs. The last thing you want is to know that there's asbestos or, I don't know, any bunch of things that can come up without having that comfort of knowing that you've had a proper inspection done and somebody's giving you that green light to say, yeah, my professional experience tells me and you that this is a solid home, right? That's just my thought, Terry. I don't know if you have a comment.
And I think it's critically important too. And I know what some people are doing to get around it is they are bringing a home inspector with them. If they see a house in the, from the outside, it looks good, the pictures look good, the area is what they want, blah, blah, blah. And that's a costly thing to do because it'll cost you several $100s to do that. But they actually go in with their home inspector. The home inspector, while they're looking at the house and deciding whether to even put an offer in, their home inspector is giving them feedback around what they face. That's a costly, but it is something that some people are actually doing right now to avoid
home inspection. Sorry, Tara, I was gonna say home inspection can easily run you between $300 or $400, right?
Yeah.
And I'd say the last comment for me is try to remove the emotion out of it. Meaning, if there's 8 other bidders, and you're really loving this house, I'd say just think of it as a home and just try to remove the emotion and have your max number.
Yeah.
And once you've gone to that number, be prepared to walk away and just know that it wasn't the house for you, right?
Yeah, 100%. Yeah, 100%. Do not fall in love with houses. Do not fall in love. Do not make an emotional decision. You will pay the price of the financial strain that it will put on you, and it's not worth it. Just know your max. Go in at your max. Give them the best offer you can, and if you don't win, you don't win. You walk away.
Yeah, absolutely.
Are there any additional incentives as first-time home buyers to reduce land transfer tax? No. Unfortunately, Toronto, Ontario gives $4,000 toward it, and that's it. And that's why not only is Toronto hard to buy in because the prices are high, but also because of this land transfer is pretty brutal. You want to take the last one? Oh, that is the last one.
Well, so do we have time? It's 7:19, Tara. Are we going right till 7:30 or?
We can go straight to 7:30.
Thanks, Ian. Okay, so yeah, there's a bunch of questions that a lot of them were answered, but we could definitely go through the list of the ones that came in advance. And the first one that sort of really came in is a good question. I'm happy to answer this one. So the question is, are there any advantages to buying cash and then taking out a reverse mortgage or a HELOC? And for those who don't know what a HELOC is, it's a home equity line of credit. I don't know what the individual is referring to when they're speaking to buying cash, but I could certainly talk to the difference maybe between reverse or HELOC. They're really two different types of ways to finance. Both have pros and cons, of course. A reverse mortgage is really for anybody that's over the age of 65. It is costlier, but it doesn't need to be repaid until a home is sold, right? And that's I would say that's probably a second option for anybody that's we talked about being house rich and cash poor. A HELOC is really just a line of credit secured against the property. We talked a little bit about that earlier. I would say, in my professional opinion, that might be the first option. And we always, at the bank, we always talk about applying for credit when you don't need it. It's probably going to be more likely that you'll get it when you don't need it versus applying when you're older, perhaps, or your income has been reduced. There's no cost to a home equity line of credit if you're not using it. So I would suggest, and what we recommend is put that in place in advance. I talked about our Manulife One product. That's essentially what we're referring to here. But a HELOC is a general term that the industry uses. And the home equity line of credit requires a principal and interest payment. So it's a little bit different than the reverse mortgage. But again, both have pros and cons. So it really depends on the client situation.
Can I answer this one that came in live?
Yeah. Oh yeah, go ahead.
Yeah, there's a live one. Is the
Yeah.
Toronto land transfer tax applicable to all types of homes, condos, detached? Yeah, as far as I know, if you're buying a home in Toronto, you will pay the municipal and the provincial tax, regardless of what type of housing it is. It's just a cost to buy a place to live in. Okay.
Good question. Okay, buying a condo during COVID. I'm going to preface this by saying I'm not a real estate agent. I'm not a mortgage broker. But I would say right now, what our experience is telling us is, in the condo market, it is a buyer's market. You could probably get something at a really good price right now if you're in a high value area. But certainly prices have gone down, and condo prices have gone down, housing prices have gone up, at least here in the GTA.
Yeah.
So Terry, I don't know if you have any comment on that with COVID.
No, I would say the same thing to you. Yeah, this is a better time to be looking at a condo right now, especially in the GTA. I'm not sure what's happening in the condo market in Hamilton, but definitely in the GTA. There seems to be a glut, and people are trying to get out of the city right now. They're trying to get away from lobbies and I think elevators, and they're getting freaked out, I think, a little bit by COVID and being in such a, where there's a lot of people. So I think it's sort of hurt the condo market in Toronto right now a bit, and it won't last forever, believe me. They'll go back up, I'm quite sure. So if you were thinking about Toronto condos, it might be a time to at least look into it. There's an interesting question here I thought I would answer. Hang on. If you were in a rental situation, could you buy a home as a rental property as an investment? Well, I think that's an interesting, again, it's all about numbers. It's all about, can you afford to keep your rental up and can you find the cash to buy a house and then, and all the costs and still be able to rent out the units and make a profit. Generally speaking, when it's just a single family dwelling, it's harder to get that kind of rent that would cover all your costs. But if you had a multiple dwelling, you might be able to find that it would be profitable. I have no problems with, trying to make, I think rental properties are it's a good investment generally, but you have to do the number. It's really a math question about, your income and expenses and the cost of the house. So in general, I would say, yeah, housing as a rental property can be a good investment, period.
Awesome. Just to let you both know, we have about 5 minutes left.
Okay.
Okay, so here's a question that I can answer. It came in through prior. And so how long does it take to finalize the purchase of a home after an offer is accepted? Great question. It all depends. I mean, my family had experience this summer. We sold our house mid-July. The closing wasn't until kind of end of October. So there was a lot of activity up front until we sort of agreed on a sale price, and then really nothing for a couple of months until we actually had to close the house end of October. That's when we had to go to the lawyer and do all that kind of stuff. So and it's a good question, because I would also say, if you're in the market to buy a home, sometimes you have leverage with that closing date. You might want to extend it further to for whatever reason, or you might have an upper hand by saying, look, I can move in a month, which might entice the seller to look at your offer more than somebody who's got a longer closing date. So as far as finalizing, that all depends on what you're agreeing upon with your agent and the individuals that are selling the home. So it could vary, in my experience, from 1 to 3, maybe 4 months.
Okay. I saw something before. I don't know if you answered it, Ian, but they were asking, how do they find the link so people want to see this again?
Oh, yeah, I did answer it.
Oh, did you answer it? Okay, because I think you're giving it out tomorrow, right? And the deck?
We'll be sending out the deck and some of the information you provided tomorrow morning for the survey, as well as I will be editing this and uploading it to our alumni website probably within 2 weeks, so they can rewatch it and gather any information they may have missed.
Okay, yeah, okay.
Do we have maybe time for one more, Terry? Do you want to maybe answer one more, or?
Okay, I'm just trying to go through. We've answered a lot of them, or just touched on it.
Yeah.
It says, how do you choose as a down payment when you don't have outside help? So it's really up to you guys. My thing is, you can't, I know there's some ways to buy with less than 5%, but I don't always felt like they were a bit sketchy. So, you have to have at least 5%. So, you do your budget. This is really a budget question. How much can you afford to pay on a monthly basis for, a payment, for a mortgage payment, and increased costs associated with a house? You'll have taxes, which you didn't have when you rented. You'll have heat and hydro. Well, generally your utilities will typically be more expensive than what you would find in an apartment, because the house is just bigger and probably costs more. And so it's running numbers, and for me, save as much as you can, and like save, live accordingly. If that's your goal, to own a home, then you make a budget to live fairly carefully until you've saved enough to move on to the next step, which is a house. And like I said, Max Money Center is here for students. If they want to run by budgets with me, just get more questions answered, you can go on Oscar Plus and just have a conversation with me, and we'll work together on trying to help you figure that out.
Yeah, and I'll just add here too, in closing, our sort of public website, manulifebank.ca, can help. We have our mortgage calculators on there, but more importantly, don't forget about those special alumni offers, right? Go onto that, the link. Ian has sent that out as well, or will be sending it out. If you're looking to shop around, or if you're shopping around for a mortgage, please consider, we've got this $1,000 cashback, which is a lot of money for a first-time home buyer, right? To take that chunk right off of that mortgage, and also that checking account that we talked about with that 2.25% bonus rate that we're offering right now for an extended period of time, so for 4 months.
Yeah. So, thank you all for hanging tough through all of this. It was a lot of information. I hope it was helpful. I think it was great working with you, Joanne. So thank you.
I really enjoyed it. Yeah.
Yeah, I really enjoyed it too. I hope you guys did. And thanks Shelley and Ian too for helping us out in the back end.